Good afternoon, everybody. So here we are at our 18th annual BDC Roundtable. Hopefully you enjoyed the morning sessions. And so now we're going to do one of our favorite panels, Ask Me Anything. We have a great set of panelists this year. We've got over 100 years of BDC experience and background with us this afternoon. I'm going to give a short presentation on each one. Al Laufenberg is here with us. He's with KBW Stiefel. He has had a huge amount of experience in the BDC area. He actually has had 25 years in the financial services industry and has raised over $30 billion. Jamie Eichen, 22 years of experience in the financial services industry and is now with E&Y Financial Services. Prior to that, you might recall that she was the chief accountant for the SEC's Division of Investment Management, and she has experience in all types of funds. In addition, we have John Waterman from RSM. He has experience with all types of BDCs as well as SBICs, and he's got a number of years, over 20 years of experience as well. And then John Zapla. He's the chairman of VRC's board of directors, and he's got 25 years of experience in valuation. And now the person who probably needs no introduction is Steve Boehm. Actually, I think if we counted it up on an aggregate basis, I think we could get to 200 years with Steve on the panel.
Thanks a lot, Cynthia. Thank you.
So let's jump in and get everybody to start answering some questions. We will be doing polling questions during the presentation. We also will answer Q&A at the end. We're going to go for about an hour. So if you write your questions in, I'll try and pose them to the panel. So what I want to say is that sorry that we're not all with each other, but one of the things that I think that I've always thought of the industry as, which I think you may have seen in our welcome video, is this industry is resilient. And I think that you'll see that's one of the things that comes across in the questions. The SEC has spent a lot of time this year talking about or writing new proposals, a number of them that obviously impact BDCs. We've tried to keep up with those. So we've talked a great deal about some of the things that have been going on. So if you haven't seen those, definitely go back to the app or to our website, because there's a lot of detail, and we've been on talking about it for quite a while. But just to bring us up to speed, let's start with our first question. And I'm going to throw this out actually to the group. And I don't think any of us thought we'd be sitting in our homes right now for the roundtable. We'd rather be having lunch and networking with folks. But since this is where we're at, let's talk about where we came from in the last 6 months as a result of the pandemic. What's changed and where do we see we're going? And anyway, Al, do you want to start us off?
Sure. So a few thoughts. One is I think what you've seen a few things is the underlying assets of the BDCs. So if a BDC had more readily available marks, you saw more volatility in their fair market value, right, on the asset side, and then the resulting NAV. So you saw that fluctuation March 31st to June 30th. I'd say also, there's a number of folks who thought in March and April, some doomsday folks who felt that the BDCs would be stressed enough that they would be wholesale liquidations and all these doomsday scenarios. Clearly, the industry is resilient, as Cynthia said. And, going forward, over the next 6 months, it's the classic, well, what kind of economic recovery are we going to be in? And then all of us could probably make pretty educated guesses from there. But what I would say is the recurring theme is you're starting to see some separation in valuation. In terms on the equity side for those entities that are performing well versus those that are struggling a little bit. And the last macro comment I would make is that in April, May, you saw not only the equity, but the debt, unsecured debt trading at substantial discounts to par or NAV. What we've seen over the last few months is a number of the sector in general has come back on the debt side. And so what that has told everybody is if you take a look at the macro, there's always exceptions, is that the investors are expecting some further deterioration in NAV for the space in general over the next 6 months. But in terms of debt, people are not expecting any kind of major stress that might impact the viability of the entity.
Great. And anybody else want to add on to that?
Yeah, I'll just note that, just going on the back of Al, just the resilience of a lot of the companies underlying the BDCs, the assets themselves. And, at VRC's seen a fair amount of different BDCs and their assets and how they've actually performed. Obviously, clearly, there was a lot of impact on companies and a lot of industries, in the March, April timeframe. The time we got to Q2, I think a lot of us are pretty pleasantly surprised at how resilient the companies were in terms of how quickly they were able to cut costs as revenues plummeted, how fast liquidity came in, and it was really the backing of the liquidity backers as well. It's the funds themselves or the equity owners, the government-sponsored programs coming in. We really expected a lot more defaults. I know I was talking to one manager that has 200 positions, and I know he said to me, he's like, "Wow, if you told me that by June I was going to have only 2 non-payments, I would have told you I had a better chance of winning the lottery." So it's really a testament to the financial community, how they've really stuck together, how fast this time. Remember the Great Recession, the time government money came in then, how fast it came in this time around. And I think it's just the structure of the companies as well. Most companies being service companies, where it's an unfortunate thing to say, where most of the cost or labor, you can quickly move labor out to rationalize the lower revenues to maintain costs. So I think that was a really big trend. I think just called coming into COVID and now kind of just moving out now.
Great. Well, let's go on. Unless John, did you have something? John Waterman, did you?
Yeah, I was going to say one thing. I compliment what Al and John kind of put out there. I think the one thing to think about going forward, it's obviously an election year. There's going to be continued volatility in the marketplace and certainly the debt and equity markets. PPP certainly helped out a lot of those borrowers through the process. We haven't seen as much with the Main Street lending program, given some of the strings attached with that. And it'll be interesting to see if obviously the administration and Congress comes together with another plan to kind of further support those, because I think we're starting to see certainly those that were able to stay the time, but there continue to be cracks kind of in the foundations, and without further support, you might see some of that kind of come out. So,
right. Jamie, anything you wanted to add?
I'll just add to what John had said on the resiliency of the industry, and I'll, come at it from a financial reporting perspective. So, we know the SEC has been active in giving relief, and I think it was really a testament to everyone's resiliency and being able to, actually operate without having to take advantage for the most part of the relief. I think, people may not have realized how much work from home people can do, getting your reports out timely and so forth. So I thought that was really, good to see.
Great. So, Steve, you want to add anything further, or did we go on to our first polling question?
Only to say that to echo what's been said, it just seems that the word resilient is a very accurate term for many in our industry, and it's been impressive to see. Great.
So we're going to try, as I mentioned, the polling question. I'm going to read it out and then go through the choices. And then if you could click on your choices, we're going to try to have a little bit of audience participation, so we have some interaction on our roundtable, and then we'll aggregate those as we speak. And we'll try and post them up so people can see them. And Samira Willis, who's been extraordinarily helpful in putting everything together, is going to help me do that, because they didn't want me to do this by myself. So let's go into the first one. Which of the following concerns keep you up at night during the COVID-19 crisis? Liquidity, maintaining asset coverage, making distributions, valuation, business continuity, or SEC reporting. Select all that apply. Excuse me. So we'll take a minute, and they'll start aggregating and we'll be able to react. And I can actually go ahead while we're pulling those together and have Al start talking about what one of the primary concerns I'm sure will come out of the polling will be liquidity. How have you seen folks maintaining liquidity, and what type of capital raising efforts have you seen that have been effective during this period?
Sure. So, everybody in March, April, people forgot about, are you going to cover your dividend? The switch was very quick. It was like, okay, we've got to focus on liquidity. And then what happened was a lot of people some people that are in the executive positions and even boardrooms, all of a sudden became very well versed in borrowing base definition and deciding and trying to understand what those borrowing base implications were. And so what you've seen is the entities that had unsecured debt on their balance sheet clearly had some more flexibility in March, April, May. And that helped some of those entities. Clearly, it's more expensive, but people definitely saw the benefit of that. And then, what we saw then was the liquidity and borrowing base issues that candidly in April, I thought March 31st was going to pale in comparison to June 30th. Well, the Fed, the SEC, they've been doing a lot of different things to be helpful here. And this collaboration, if you will, you've seen a recovery in the debt markets in May into June, and that helped the June 30th valuations because the overall bond market improved, et cetera. So what you've seen is that, there's been all types of different capital that's been raised. There's been some rights offerings. There's been some unsecured debt, and they've been at wide ranges of debt, depending on the facts and circumstances in terms of dollar amount and also interest expense. And clearly there's been some modifications to existing credit facilities to take into account. In general, what I would say is that the industry all has accepted the notion that none of us saw this coming, and no one is blaming anyone. It's more about how do we fix this and how do we go forward. That's generally been the capital markets point of view.
Great. And you mentioned some of the different types of offerings out there. Do you think you're going to see more rights offerings, and how did the market receive them? I think there's one participating preferred offering out there. What do you think about those types of answers to some of this?
So rights offerings can be pretty polarizing. Clearly, you can make the case that it's not dilutive to any shareholder because they all get to share in the dilution. But the facts are, generally speaking, NAV is going down per share. And so it's an interesting reaction. There clearly were some shock and very strong emotional reaction from one or two of the entities when they announced a rights offering. It's from some of their investors. Because they just didn't see it coming. But I think as the investors understood and got past the emotional reaction, most of them understood it and viewed it as they viewed it constructively. I would say for the rest of the industry, it's no longer you have to be the first. And with a rights offering, sometimes being the first is not always the best thing. So with rights offerings, clearly any manager who decides they want to raise capital in a rights offering, they need to think long and hard about it because there will be still a strong reaction, and some of it very negatively. But with that said, if somebody has a good use of proceeds, I think the key is how does it impact the dividend? Because during the financial crisis, there were entities that did rights offerings, clearly below NAV, but they were able to do it to help their dividend. Because there was a great vintage, if you will. So what I could see a scenario is the rights offerings going forward. Let's assume the economy is flattish from where we are right now. Then the rights offerings will be generally the ones that have been raised. Some of them have been very much proactive, very much playing offense. But I think there will be this vintage of originations that people want to take advantage of. And people will be able to say, oh, it's not secondary trades, but more primary issuances. And so what will happen is I think the investors will be more open-minded to those rights offerings. One, because they were initially surprised by the first, now they won't be. And two, if there's a good use of proceeds where they're saying there's a great pipeline, not just buying distressed debt or buying things or helping out the existing companies, but actually new companies with great deals, great terms. You saw this in the financial crisis. One of the benefits of me with the gray hair and being around for a while, I remember that, as do some of my fellow panelists. And the answer is we think there could be some future rights offerings, but it's case specific. And you got to be very thoughtful about it as a board and a management team.
Great. And Samir, do you want to show us the results? And I think you can see, everybody can see them on their screen. As we suspected, liquidity is definitely at the top end, but valuation, well, actually, excuse me, valuation is at the top end. Liquidity is second, and we'll get to valuation in just a minute. But I think that's very interesting results. Maybe we can go to the second polling question, which is, where do you see the most interest or growth of potential BDCs in the future? Traded BDCs, non-traded, private, multi-class, or private funds? So if everybody could choose their answers, and Al, why don't we start with you? Where do you see the industry going? Are we talking internally, externally, traded, non-traded?
I would say one overall theme is scale, size. And that's when you've seen some of these mergers with affiliates, you've certainly seen it there. You've also seen it with some of the traditional M&A transactions that have been between two third-party entities. Scale matters. And if you think about it, it makes sense. And even it's not just BDCs. If you think about the financial institution world, banks, commercial banks. We talk to commercial banks that are 500 million assets, they want to be $1 billion. We talk to entities with $1 billion of assets, they want to be $2 billion. We talk to entities with $10 billion of assets, they think there could be $20 billion. And the reasons for it are different for each situation. But the recurring theme is there are benefits to the shareholders with some additional scale, either with improved costs, overlaying some of those inherent fixed costs. And then two, with the market being so much first lien unitranche, so many of the private equity firms, when they go to put out for bid, they'd rather deal with one party than multiple parties. And so if somebody can take down 50 million instead of 25 million without adverse concentration in the portfolio, it makes sense. So as a result, these credit platforms, including BDCs, want more scale. And so do we see that trend to continue? Yes. Do we see some internally managed entities? Investors would love to see more internally managed entities. But, that scale kind of puts it at a little of a disconnect. So you have to think about your market. So venture lending is a classic example of a niche player that you're not have to be 20 billion in assets to be meaningful. One would suggest energy, but not in this current environment. And then you also can look at an entity like Main Street. They've been very effective at lower middle market. And so that market, you can be very effective and be of good scale. But when you're talking about a traditional financial sponsor coverage, PE-backed, first lien, market, EBITDAs of 10 to 40 million, well, you know what? There's a lot of competition for that. And so scale matters. So we do expect that trend to continue in the BDC space.
Great. Well, and Samir, I don't know if you want to show everybody. Obviously, we've seen in the past couple of years that there's been a number of private BDCs started, and we can talk a little bit further about that. But I thought that's interesting, and as well as obviously private funds that BDC managers are looking at. But John Zappala, can we talk a little bit about valuation, since everybody's noted that as one of their top concerns, or what's keeping them up at night? So you're anything you'd like to say about that process, how the analysis has changed, or any methodologies that you're using differently? John, I think you're on mute.
Thank you. I am on mute. Apologize. Yeah, I guess in terms of, obviously the focus, as I mentioned, on asset valuations, with COVID impacted companies. And I mentioned, we've been pretty surprised by the rebound. In terms of what we were doing, and we continue to do, methodologies really haven't changed. Maybe we're doing a little bit more impairment analyses on some impacted companies, but generally the methodology is the same. Processes, yes, have changed. I would say that what's come out of this is more accelerated timelines and earlier starts to the valuation process, as frankly, managers or advisors want to have more time internally reviewing valuations or having time to prepare valuations. And became a theme of valuation memos or monitoring slides from the managers was, the COVID-19 impact. And that really was around assessment on revenue impacts, what management was doing to manage costs, how they were managing liquidity, how they were working with their sponsor, did they breach covenants, how were they working with their banks. So that in terms of process, there's a lot more diligence, enhanced diligence around the company valuations. It clearly just took a lot more time to do. Then also the other buzzword was on, what EBITDA base we're going to use. And for a while, people were throwing out terms like EBITDAC, EBITDA, adding back Corona or COVID-19 impacts. That never really took on. The lenders, holding the covenants really held to, not having those types of add backs. But, there was clearly, there was amendments being done. You were going to reset covenants. And the questions were, well, what EBITDA we're going to use? And, people started looking forward, to the next 12-month EBITDA data without, the COVID trough, which is probably fair. Some looking at 2021 numbers, but also, factoring in trailing 12 as well to show some impact of COVID, because we could legitimately go into a, possibly a double dip type of recession or impact from COVID in the wintertime. And last I saw, economists were still, that was their base case, as we got into the wintertime months. So it's really what we were seeing in terms of process and methodologies.
Great. And so let's look at what, what's been happening with LIBOR. And we got another audience question, which is, do you feel your BDC is adequately prepared for the LIBOR transition? So choose your answer, and we'll get John started on a discussion about how he sees the change impacting the valuation process.
Yeah, thanks, Cindy. I'd say it's still pretty early days. You have until the end of 2021 before LIBOR falls off. I think generally the BDCs are positioned well just from their documentation, the way they're written. They already have like built-in fallback rates from LIBOR. You have prime rate or a Fed funds rate with different spreads. So clearly, I would see that they would start factoring a different fallback rate when LIBOR starts to phase out. Right now, everybody's waiting to see, just like us, what standards is going to fall out. Right now, the Fed is recommending they're calling the secured overnight financing rate, or SOFR acronym, and that's basically based on actual transactions in the repo market. And if you recall that. The problem with LIBOR, it's not based on any market transactions, it's based on surveys, so it can be manipulated. So everybody's trying to find globally a rate that's really based more on transactions. Now, the downside is it's secured by Treasury, so there isn't really true counterparty risk being measured. And because it's the overnight market, there's no term structure. Players are still looking for ways to hedge and looking for swap rates or forward rates to be able to hedge. So until those markets really develop, it's going to be hard to take on. Now they're talking about being able to trade future SOFRs, and that'll create a term structure and a swap market. But it's pretty early. There's still two alternatives out there. There's a bank yield index that's being proposed by ICE. They're the people that monitor LIBOR right now. And that's set to launch later in 2020. And that's going to have multiple tenors, and that's supposedly going to be based on transactions as well. It's based on the bank market, and there'll be a credit component to it. And then there's a term of Ameriribor is being thrown out there. Right now, the futures are trading on CBOE, so that's going to have a forward component as well. But still, there's still not one component out there. So I think the BDCs are really waiting to see what kind of plays out, what kind of sticks before they gets factored in. And once we see that, we're obviously going to monitor amendments and credit documents. And for us, we presume like a Cap IQ or Bloomberg is going to pick up those new measures, and we'll be able to factor those into our models, pretty effortlessly. We'll be able to change our templates and roll those in, as that changes.
Well, it looks, from the way you're describing it, sounds like everybody's with you on the fact that they think that the BDCs at the 61% are pretty well set. There is the SECs out there, I think, with some sweep questions for folks, just to make sure that everybody is kind of getting ready, and that process has started. Going on to another polling question. The SEC recently proposed a new rule that would establish a framework for fund valuation practices. Do you think the rule will change the board's role for valuation process, cause advisors to be more involved in the valuation process, result in more consistency, or no change? So you can choose those. And John, again, if you could maybe talk about what you think is going to happen as a result of that rule, if anything, new rule.
Well, I mean, ideally, it's supposed to produce more uniformity and consistency on the process in terms of methods, and, uniform reporting, and then setting up the responsibility level of the board and of the advisor, and with third parties as well. Right now, the board still has the monitoring and oversight function. Now, what the reg is basically saying is like, hey, listen, you can delegate the valuation process and the function. You don't need to be responsible directly for coming up with the valuations, but you need to, you have to have controls and a process in place. And the rule basically outlined some steps that the board's supposed to do. They're supposed to look for conflicts of interest. They're supposed to periodically manage, monitor the risk. They're supposed to look at the third-party valuation firms, look at quality, look at the consistency of methodologies, consistency of process, looking to the advisor and making sure, they're following, the process, the rules. So, clearly it's creating more responsibility and oversight on the, the advisor and the fund manager on the actual valuations themselves.
Okay. So we've got the audience response, and to some extent, I think they're echoing what you were saying, is that there's really not a lot of change as a result of this rule. I do think that this has been a rule that was expected for a long time. It's been over 30 years since the SEC has put out new guidance, and I do think that when it ultimately was proposed, it looks very similar to what folks are doing, so it's coming in line. You see any real change in the relationship between the board and the advisor as a result of this rule?
Well, I think clearly it's distinguishing duties between the two, and it's putting more responsibility on the board, and on the advisor to carry out a process. So, clearly they're going to have to spend more time with each other. So it's probably going to increase more time for the board on the process, and it could create more challenges between the board and the advisor, and maybe more conflicts, with the delegation, and having more checklists to fulfill for the board. So clearly there's going to be more interaction, with the advisor. So it could create some more conflicts, a little more friction. You hope not, but that's a possible repercussion of that.
So just to make it confusing, for another John Waterman, to maybe talk about whether you think that any of these proposed changes will have an impact on the audit or the auditors.
That's a good question, Cynthia. And I would say wholeheartedly we support the changes that the SEC has proposed. And I think the audience kind of hit on it. Almost 50% don't believe there's going to be a significant change. I would say what we've seen currently in practice, the boards obviously take that oversight seriously, but they do delegate that responsibility to the advisor, to the managements, to kind of work up and help present to them what the valuations need to be. So the ones that are already good at it, I think there's not going to be a whole lot of change. The ones that probably may lean more on the advisor are going to need some help with some of that. I think it's interesting, the proposed rules that the SEC put out there. Two things that caught my attention. One of it talks about the boards oversee with a skeptical and subjective view. And not that they didn't already, they obviously have the fiduciary responsibility to maintain that. But when you see the SEC specifically put that in there, they want to make sure the boards are not just passing it off to management and then just, letting it run. So I think you're going to see a lot of perhaps more process be put in place. They're certainly going to hold the boards accountable. They already are. But I think you'll see more of that and probably some more structure around the valuation process, as John kind of pointed out. So as for from an audit process, I don't see a whole lot changing from our end in working with our clients because, again, the BDC community has been pretty good so far as to using having the right people in place to really get at the valuations or leveraging third-party valuation specialists such as VRC. So I don't see that a whole lot changing. Maybe it's a little bit more lift for some folks outside the BDC community, but again, more will come with that.
Great, and then maybe we can just lead into any accounting changes. What are the biggest changes you've seen for BDCs over the past year?
Well, we talked a lot about it already. I think the two big ones are valuation. Obviously, our clients navigating COVID 6 months ago, trying to figure out, do you have direct exposure to COVID? Do you have indirect exposure to COVID? Do you not have really exposure to COVID? And trying to, figure that out at the March 31 valuation period. As my colleagues here kind of pointed out, June 30 kind of recovered a little bit. We've got volatility kind of still in play. With the election coming up, we anticipate the next 6 months are going to continue to be challenging from a valuation perspective. It depends if Congress comes together with some significant aid to continue to help portfolio companies of the BDCs. They have been resilient, but we're starting to see some cracks still kind of poke out there. And then we've already, Al commented on the liquidity piece. I think, our BDCs, and I getting up today, I thought I'd throw in some camouflage because our BDCs have been, duck and cover from, in March 31, everyone was pulling all the available capital and collateral they had with the BDCs, the lines, and working through that. They're going to continue to need the liquidity to obviously manage where they're at, the existing portfolio companies, but also make new loans and new equity investments. And that's what, the investors want to see. It's up there. So the two big things that we're continuing to see are valuation, liquidity, and obviously navigating the next 6 months. So.
Great. Well, and maybe we can go on to the next polling question. There was a new rule on significant subs. So the question we have is, do you expect your BDCs to be affected by the new significant sub rule? And Jamie, maybe you can take us through that, maybe explain why we needed it a little bit, and then what the change is. And folks can...
Yeah, sure, Cynthia.
Thanks.
Yeah, no problem. Yeah, I mean, I think it's going to be a good thing for the industry. I think, the application of these new rules will probably result in fewer controlled investees being deemed significant subsidiaries and fewer waiver requests. And, that really kind of answers why we needed it. The problem with the old definition was that there wasn't really a definition that was tailored to investment companies. And so then there were a lot of anomalous results coming out, which would make certain controlled investees, deemed significant. And then there'd have to be a lot of waiver requests. And I think, the good thing what the SEC had done with this is before proposing it, the staff had actually come up with this model. And then when they were getting these waiver requests, they were looking at the facts and circumstances of the waiver. And if they were not significant subsidiaries under this new model, the staff would likely grant a waiver. So this model actually has been tested, which I think is a good thing. That being said, I think there could still be certain anomalous results that could require some waiver requests, but I would expect a lot less. And, just at a high level, what the SEC had done here is the significant subsidiary test have really, the old test had three different components: an asset test, an investment test, and an income test. And so what the SEC had done is they got rid of the asset test. So now we're just left with an investment test and an income test. The investment test is almost the same. Basically, what you're doing on the investment test is you're comparing the fair value of the controlled investee to the total fair value of your portfolio, where in the past the denominator was total assets. But that's the investment test. The percentages haven't changed. Now, from the income test, this is where I think people will see the most benefit. The income test is actually now a two-part test, where if you fail one of the parts, you're a significant subsidiary, but it's a higher hurdle to fail. So for the first part, what you'd have to do is take a look at the P&L you're receiving from that subsidiary. So you would take, your gross investment income, your net realized gains and losses, your unrealized gains and losses, take the absolute value of that, and then compare it to your bottom line net income. And if it exceeds 80%, you're a significant subsidiary. If not, you essentially move to part 2 of the income test. And that test is really a dual prong investment test, income test. So you would have to meet both prongs to be a significant subsidiary. So you'd have to fail the investment test at a greater than 5% threshold, which is important because a lot of fails in the previous regime, you'd write down an investment, you'd have, large unrealized, but it would be, $0 value in the portfolio. So it really didn't make sense to provide additional information. So you'd have to fail that piece. And then you also have to fail the income test that I just discussed, either at an over 20% level for 309 or 10% for 408G. So I think it's going to be better for everybody. From what I understand in talking with the staff, they have not gotten any waiver requests thus far. I think they're open to entertaining waiver requests in the event that people still are failing the income test because maybe your net income was flat for the year. If you fail the investment test, likely not going to get a waiver. But I think it's good. I think they really did a good job on this one.
Great. And I do think that the polling said that it doesn't look like it's going to affect many people. I do think that depends on how many control transactions you have and whether, as a result of the environment we're in, you see more of that. But it's something to keep in mind. Jimmy, maybe you can talk for a minute about the offering reforms and whether the process is going to change. This was a pretty big thing that the industry had looked forward to for quite a while. Anything that you'd like to pass along on the offering reform?
Yeah, the offering reform, I think, is being looked at very favorably, particularly for the BDCs who could be WIXIs or, who would meet certain other requirements in order to, forward incorporate by reference their financial statements. I think what was happening under the old regime, which was sort of problematic, is you'd have to file an update to your registration statement in order to update the registration statement with financial statements, which would then trigger staff review. And sometimes you'd be waiting for the staff to approve it. Now, if you meet certain requirements, you would be eligible for forward incorporation, which would mean that the auditor, when you're issuing your 10K, the auditor is basically issuing the consent at the time you're issuing the 10K. And then the 10K will get incorporated by reference into the registration statement, which I think is good news. So there's a whole lot of good things from a legal perspective. I'd also say, we get some questions from a comfort letter perspective. What does that mean for your comfort letter process? And, our comfort letter process hasn't necessarily changed. Our standards haven't changed. What we're doing in the comfort letter, we're still providing negative assurance on certain non-expertized sections in the registration statement. But, where I think some questions come up is that maybe, because of incorporation by reference, whereas, 10Ks or 10Qs used to be included in the registration statements, now with incorporation by reference, some folks aren't realizing until late in the game that they're going to need information to be comforted by the auditor. So, if, you kind of take the most extreme situation, say you haven't done a shelf takedown all year, and then all of a sudden you're going to do a shelf takedown in the fourth quarter, we're going to have to comfort information from your prior year 10K, your current year, your 3 10Qs, and that does take some time. So you just, want to make sure you give your auditors time to do those procedures and work with your underwriters, see what they need comforted, just, in the event that certain of the information is incorporated by reference and, it may not really trigger a thought process that you need to work with the auditors on comforting. So, but all in all, there was a lot to the offering reform, a lot from a legal perspective, but I think it's been looked upon very favorably by the industry, and it's something that people really have been clamoring for years.
So it's a mostly build it a little more time just because it's new on how you're going to pull everything together. Going to the next polling question, are large accelerated filers basically ready for reporting the critical audit matters, known as CAMs? As CAMs continue to be phased in, are you prepared? Yes, no, not applicable. Jamie, maybe you can talk why we're aggregating the polling results.
Yeah, and so just quickly, for those of you who may not be familiar with CAMs, generally these are matters that we have to communicate or are required to be communicated to the audit committee that relate to accounts or disclosures that are material from a financial statement perspective and that involved auditors, especially challenging subjective or complex judgments. To the extent we identify CAM, we have to identify them in the opinion. We have to say why they're a CAM and what we did to audit the CAM. And these rules were effective for large accelerated filers last year, and now they will be effective for all BDCs except for emerging growth companies, starting with the 12/31/2020 audits. And I think, from management's perspective and the audit committee perspective, you really want to make sure if you haven't had to deal with CAMs last year, or even if you had, in the event some are changing, you want to make sure you're engaging in a dialogue with your auditors, understand the process, understand the CAMs that the auditors are thinking about. The last thing you want is surprises in the last week of February on the CAMs or the wording and so forth. And also, a lot of the firms do have quality review protocols. So there is an extra layer of quality review outside the audit team. So, for example, I review all of our BDC CAMs and our public asset manager CAMs. So it's another layer of review. What we've been trying to do for our clients is, to the extent we're issuing CAMs in connection with our Q3 board meetings and audit committee meetings, we try to provide them, the audit committee and management, with a draft in advance that's been through the quality review process, just so people can take a look, start getting comfortable with the wording, provide any comments, just to give everybody enough time to digest. I'd say from the issued CAMs, probably not surprising from what we've seen from the large accelerated filer auditors. I think every BDC has a valuation CAM, which is not surprising. They all pretty much say the same thing when you cut through everything. So, not a whole lot there. That's going to be very surprising. One BDC had an income recognition CAM on CLO income recognition, and then there were transaction-related CAMs. So if there was a merger or asset acquisition, not surprisingly, that's a CAM. Two other pieces of advice I would give you is, something that came up when I was reviewing these large accelerated filer CAMs. Our audit teams do not want to be in a position of having to communicate original information when we're writing up the CAM. So there's been some situations where we thought, in order to properly write our CAM, management may need to enhance their disclosure in the filing so that we as auditors would not be communicating information that management hasn't otherwise communicated. So that's something to think about. And then this process also resulted in management taking a harder look at their disclosures of critical accounting estimates in the MD&A. And while there's no one-for-one correlation between a CAM and a critical accounting estimate, there is some pressure if managements are making these disclosures about these estimates, and we're not saying that they're CAMs. So in some cases, management really thought about it and reflected and maybe reduced some of the critical accounting estimates that they were disclosing. I think it'll be interesting from a regulatory perspective. It's kind of been quiet from the PCAOB. We'll see if they issue any guidance this fall. And then from the SEC's perspective, from my understanding, they're not reviewing the sufficiency of the CAM. They're leaving that to the PCAOB, but they're taking a look at BDC audit opinions and if they should have adopted CAMs, making sure that there are actually CAMs in the audit opinion.
Right. So the polling results, obviously, I think there's a good portion of the folks who it's going to be applying to likely this year. I'm a little concerned about the not applicable because CAMS is coming to everybody, I believe, at some point. So anyway, just to keep in mind that even if it's not applying to you for this year's audit, that you want to be monitoring what's happening and take into account what Jamie was saying regarding the fact you might have to do some additional disclosure or revisions as you get towards using the CAM. But and Jamie or John, and we're running out of time, so I just want to mention the PCAOB and the fact that they're also proposing a fair value measurement standard, and how that might interact, and maybe just a sentence or two on that from both you guys. And
Sure, I'll start. The standard is effective. So there's two standards: a estimate standard and a specialist standard that are effective for the 12/31/20 audits. I think the good news is I don't think there's going to be a big impact on how we audit BDCs. I'll sort of leave it at that, and spare you any details. And John, if you want to make some comments, feel free. But I think that's the good news of this.
Yeah, I second, Jamie, what you're saying. It's not a huge lift or change from what we're doing. It's continuing to look at those, specifically the one on the specialist, and making sure that management and we, as pulling in our evaluation specialists themselves, just make sure we're monitoring and following the standard. So.
Okay, great. So on to Steve, and as we get down to almost to the end, the second to last polling question, the SEC recently issued a rule proposal that would provide limited AFFE relief. Do you think this rule will bring institutional investors back to the BDC industry, yes or no? Steve?
I think the answer is yes, and it's yes because of the following. This has been such a arduous task to get to the proposal stage. I feel like it's taken hundreds of years and thousands of lives. All of us have been involved in this process. And of course, what the rule would have is if a 40 Act company invests less than 10% of its assets in acquired funds, then the costs, the fees associated with those funds would not have to be a line item in the fee and expense table, but rather could be relegated to a footnote. So what would this mean? This would mean that mutual funds would seemingly be more willing to invest in BDCs. If that's the case, then the indices would be more likely to include a BDC or two. If the indices include BDCs, then BDC assets should accumulate at a faster rate and you get scale. And once you get scale, I think institutional investors will feel more comfortable going into BDCs. With so many smaller BDCs, institutional investors tend not to make those investments. They do in the larger BDCs. And if you get into indices, that means that more mutual funds will reflect that BDC, and therefore scale will increase. So the answer, I think, is yes. To be determined how much, but it's certainly at the margins, the answer is yes.
Right. So it's potentially a good step. Whether the 10% is the right number, who knows? And the indices will make their own judgment as we move forward. But it's a step in the right direction, even if it might be more of a baby step than a full-blown stride. What about? And I think that we can show the polling from that. But if we can go on and talk for a minute about offering reform and how you think that's impacted BDCs, or anything you'd like to mention.
Well, I think Jamie did a good job of describing the impact of offering reform from her perspective. Of course, the immediate reaction of the industry to offering reform is hallelujah, although effectively a number of BDCs have been acting as if the reform were in place because, as you know, Congress passed the requirement in 2018 that the SEC adopt these rules, and they were supposed to adopt them within a year. In 2019, March, the year anniversary, a lot of BDCs started to follow those rules as if they were in place, and eventually the SEC decided to voice no objection to that. Now that it's official, I think the industry can relax. There's no more issue as to whether these very helpful rules apply. Obviously, they can incorporate by reference. Obviously, if you're a WIXI, you can have immediate effectiveness and all that goes with that. And of course, free writing and access equal delivery is all very beneficial. So I think it's all good. But I would say that I'm not sure, while it's great for the efficiency of the process and it's bad for the lawyers, which I guess is good for everybody else, I don't think companies make financing decisions based on how arduous the registration process. I think financing decisions can be frustrated by the nature and length of an SEC process. So I don't think this is going to fundamentally change the way companies go out and raise money, but I do think it'll make the process simpler.
Right. So, and just, it looks like the poll, almost everybody agreed with you at 83%. But going on to the last polling question, the SEC surprised us, I think, a little bit, and they recently amended their accredited investor definition. It hadn't actually changed since the 80s. Do you think those changes are going to substantially increase the investor base for which private BDCs are able to raise funds? And yes or no? And Steve, what do you think?
I think the answer is only at the margins, because if you look at the categories that have been included, that is folks with certifications such as those that go to broker-dealer licensing, family offices, and other entities with more than $5 million, knowledgeable employees. I think it's only going to help at the margins. Certainly in a traditional private fund, which is a private fund that's really looking for large slugs of money from institutional investors, this is going to have no impact. I think the impact will be felt, and again, I don't think it's going to be great, but it'll be marginal, will be in those retail-ish private BDCs, the ones that go out and actually sell in a way that's not fundamentally different from the non-traded BDCs. That is, they're getting smaller slugs of money from a broader group of individuals, but even they're looking at folks that are a little bit higher than accredited. So I think this will help, but only at the margins.
Right. And I think that, again, people are in violent agreement with you. I think that it's not necessarily going to change the landscape in a huge way, but I guess it's incremental. So we've now come to the end of our prepared discussion. I am going to go to the Q&A and see if there's any questions that folks have put in here. I'll have a little fun with, just because I can read it. It said, one of the participants said, "Isn't it 200 years of experience that just BDC alone, just Steve Boehm alone?" So I had to get that in there.
Thank you. Who are these people?
So just on a more serious note, we'll take one or two questions for John Zappala. As the pandemic unfolds, valuations were initially impacted by market price and valuation metrics, but now there is a clearer picture on the company's performance, and companies can get a handle on budgets and forecasts. Given the emergence of the performance data and updated expectations, how do you see valuations being impacted in the third quarter or fourth quarter? John Zappala?
Got it. Yeah, I guess I have to pull out my crystal ball on this one. So clearer picture, obviously be clearer good or clearer bad. As I mentioned earlier, most of the companies have rebounded pretty nicely. So right now, if you go with the momentum that we've seen, enhanced forecasts, or I guess the buzzword in Q2, and as we're getting into Q3 is we beat our COVID forecast. So coming out of COVID, everybody revised down forecasts. They've outperformed them. Now starting to revise up. So clearly, the industry is more optimistic. I would expect valuations to be probably stronger unless you have a double dip, impact from COVID. The election's obviously another wild card, can go the other way as well. Right now, we think the other equation is obviously fundamental performance of the company, as I mentioned, going in the right direction at this point. Also the market side, the technical side of things. Right now, I think the market's pretty stable. We saw yields come in just, a bit, especially in the public markets. The private markets, I think, have stabilized from what we see. Clearly, the BDCs need a minimum return to make things work in terms of their dividends. So I don't think we're going to see much price compression there. So we think we'll probably see stable yields there. So a little more optimistic on valuations going forward. I know we started having our conversations with market participants regarding their pipelines and what they're doing. They've clearly moved a lot of them that have good fund liquidity situations from playing defense, meaning portfolio monitoring, to more offense, actually putting money to work now, going out and doing deals. We're seeing more M&A activity, especially in the tech space and the healthcare space. So there is a pipeline of deals. A lot of our larger clients are pretty optimistic with deal activity in Q3 and Q4, and even heard the buzzword of dividend recaps. If there's a change of guard in the White House, where there's more onerous tax rules, especially on the private equity community, trying to take some money off the table before those tax rules change into 2021 could be a catalyst as well for deal activity. So we'll see how that all plays out, but still a little bit nebulous, optimistic regarding at least company performance and the stability of the economy. But, clearly the election can change things. COVID could change things without any kind of vaccine.
Right. So one more question, and it's going to go to Al. And the question is, please discuss the current status of the equity and debt markets and the ability for BDCs to successfully do either a bond or equity offering, and current pricing for bonds. Include the discussion the next 12-month horizon. So I don't know if you need to do all of that, Al, but any kind of comments you'd like to make, maybe beyond just today or the last week, what can you offer up as far as where we are with debt and equity offerings?
The markets on the debt side are open. The question is at what price? So, you have the largest names with all three, the rating agencies, investment grade, those things are being done with a 4 handle. You have where if it's just one rating, investment grade, maybe it's a 6 handle. Maybe it's 7, depending on the facts and circumstances. If somebody's not rated and there's a little bit of a story to it, well, then the answer is maybe you get something done, but maybe it has to be more secured. Maybe it's high single digits. And so the market is being brutally honest in terms of what they are willing to do and not do. And on the equity side, you clearly are seeing a few entities trading above NAV, but not very many. And so then the question is if you do a rights offering, generally speaking, rights offerings, you want to have some perceived smart money to be involved. So that means an anchor investor, if it's a rights offering below NAV. So insider participation is meaningful. You get an institutional investor or two to back it. Those are ways to go forward. So as you might imagine, I'd be happy to talk to whomever who has that situation.
Yeah, I thought that was a good way to end, and a little bit of a softball for you on this one. But so I just wanted to thank everybody for our panel of experts, and hopefully we touched on topics that were of interest, and you thought the polling was helpful to understand. Most of the presentations we have in the panels that we have over the course of today and tomorrow really kind of augment some of the subject matter and issues that we've already been discussing. So please access those. And I just want to say thanks to everybody, and we look forward to actually seeing you and face to face, and be safe and healthy. And we'll see you soon.
Thank you.